Let's start with your view on the bond market, because it seems to me that you could say yields are so high, and if the Fed's going to be so aggressive to bring down inflation and cause a recession, isn't there a point where it's time to buy?
So I think there are parts of the market that are time to buy. I mean, if you think about what's happened, this has been the fastest hiking of rates that we've seen in history. By the way, simultaneously, the bank's been draining liquidity, $1.3 trillion from the peak in December. So this has been a historic move higher. You've now pricing, or you got to pricing the terminal rate or the funds rate at 5%. I think some of what you said earlier is really important now. Now we've got to see, when you see the mortgage rate, as you said, over 7, now you've got to see, and I think the Fed will start talking about we're getting closer to pausing, and certainly slowing down the rate hikes, as you've seen Bank of Canada and others. So I think that's a big deal. So front end of the yield curve, gosh, to buy front end assets at treasuries at 4.5, but also if you go into things like credit securitized assets, you can take not a lot of interest rate risk, not a lot of credit risk, and still get paid 6%, 6.5%. That's pretty attractive today. You don't have to worry about the volatility longer on the yield curve or down the credit spectrum. I think there's something really important, though. We're not easing. So people describe it as an inflection point. Not really an inflection. All it means is you're going to slow down the pain that has taken place up to this point. So you're going to pause, and I think where the Fed's going to be, you're going to pause at a place that's restrictive, which still dampens economic growth, still should dampen inflation. And so that's a really big deal. It's not like we're going from tightening to easing. We're just going to slow down the hikes and then pause at a place that's still restrictive. I mean, you have to expect in an economy that's slowing, you have to expect default rates pick up. You have to, as you describe, you've seen some gearing and so maybe some implicit leverage that comes through in terms of easier financial terms for high yield companies, leverage loan entities. And so you have to be a bit more careful. Boy, the yields, though, are pretty attractive when you can buy single B high yield back at 10%. So the point being, take a bit of exposure, but be careful about how much you take. And we're running a lot lower than we've run historically. But boy, these yields, if you do your research around some of these companies, you're pretty comfortable. You can feel pretty comfortable. A lot of them have turned their debt out. Their free cash flow is still pretty generous. But would I rather stay in higher quality? I mean, boy, this is the first time in years you could stay in on the yield curve in high quality and still clip really attractive yield levels. So I'd rather do that for a while and see what plays out from here.
Rick, I have to ask you, since we've had the big concern, illiquidity in the Treasury market, I've interviewed Loretta Mester from the Cleveland Fed, Jim Bullard from the St. Louis Fed, and neither one seemed particularly concerned about the financial instability, though they would kind of acknowledge a little bit of illiquidity. What do you see there? Are you concerned?
So I'm not concerned structurally. The illiquidity, by the way, it's everywhere. The illiquidity amount I trade equity options, I trade treasuries, I trade inflation swaps. The illiquidity is everywhere. And, you have to be there. And, why is that the case? It's the case because the conviction levels are so low across the globe. When you think about putting money to work, you can look really silly in 24 hours. So people are very cautious. And so I don't think there's a structural issue in liquidity. I just think this is a natural period of uncertainty, and where people are like, you know what, I'm going to wait, I'm going to see some things transpire. And so the depth of these markets, all markets, equity markets, et cetera, the depth is incredibly shallow. It's why you're seeing across the globe these massive moves, one day one way, the next day a different way. Markets are just super thin. And by the way, the volumes can be heavy, but the liquidity at a price is really shallow across almost every market.